Let us start with our next question, and before that I would like to give you explanation about the concept of inflation, which we are going to understand over here in this segment. We are starting with a new segment, that is the decision making in inflationary situation. That is the next segment that we are going to start. Dear students, we are going to understand the decision making if we are provided with the information that there is inflation. If at all inflation information is given, then in that case, how to make the computation of the cash flows for the purpose of decision making, that is what we are going to discuss over here. As far as the decision making technique is concerned, it is exactly the same. That's the NPV or IRR or NPV index or profitability index. However, basically what happens that the calculation of the cash flow is going to be slightly different. How to make the calculation of the cash flow, that is what we are going to understand over here, and that is going to be slightly tricky point for the purpose of decision making. Over here we are going to understand how to make the calculation of the cash flows, and ultimately the decision making is going to be the same as what we already have understood. The decision making is not going to change. The term inflation is what we understand is the same product is having more price is considered to be inflation. Maybe the product that say we are selling, or maybe say the cost of the raw material to us, or cost of the labor to us, or cost of the overhead, all these expenses say go on increasing, and so the revenue may be increasing in the same proportion or in a different proportion. This is what we are going to understand. Initially, we will focus only on the calculation of the cash flows, because calculation of the cash flows are going to be important. And then say the decision making, in that say we are going to understand something like called technically nominal cash flow approach. Technically it is called the real cash flow approach. How does say these like the decision making technique works, that is what say we are going to discuss over here. The same NPV calculation in a slightly different manner. This is what say we are going to understand. I'm starting with a small numerical, and then we are going to like write even a note for this when I will discuss say to some extent wherein certain points which are very important that I want to dictate. Starting with our next question, dear students. On 1st of January, ABC Limited is considering, highlight the portion, manufacturing of a product. Life of the product is 3 years. Highlight the portion, current price of the product and current price of producing the product is as under. So today the price at which the similar product is sold in the market is 600, and today manufacturing of this product is having a cost of 200. Expected sales units have been provided to us for end of year 1, for end of year 2 and end of year 3. Investment is to be made rupees 1 lakh. Highlight the portion, inflation rate is say 10%. There are two questions. You are required to compute the real cash flow, or the question may provide cash flow in current purchasing power term from end of year 1 to end of year 3. And then the second question is compute the nominal or inflation adjusted cash flow again from first year end to third year end. I request all of you to go through the question, please. Let us have a discussion how to calculate answer of the question. Do not write anything. Dear students, the question says that you are required to compute the real cash flow or the cash flow in the current purchasing power term. What does it mean? It means that say for the time being we are required to ignore this inflation. Ignoring inflation, we are required to make the calculation of answer. Selling price is provided to us as 600. Sales units are provided for the first year, second year and third year. So what will happen, dear students? Selling price into sales quantity. That is the way the sales value will be calculated from end of year 1 to end of year 3. I request all of you to write answer. Calculation of real cash flows or cash flows in current purchasing power term means cash flow calculation ignoring inflation. Full stop. In that write down end of year 1, end of year 2, end of year 3. First of all, we will write sales. Selling price is given as 600. Sales quantity is given as 1000. Again it is 600 into 2000. Again it is 600 into 3000. So in that case it would be an amount of 6 lakhs, an amount of 12 lakhs, an amount of 18 lakhs. Next is variable cost. As far as the variable cost is concerned, it is 200 into 1000. Again it is 200 into 2000. Again it is 200 into 3000. So that comes to 2 lakhs. That comes to 4 lakhs. That comes to 6 lakhs. There are no other information. So difference of both of them is the cash flow. So end of year 1 it is 4 lakhs. End of year 2 it would be 8 lakhs. End of year 3 it would be 12 lakhs. We could have done even directly also 600 minus 400. I'm sorry, 600 minus 200 is 400. 400 into 1000. 400 into 2000 and 400 into 3000. That is also the way we could have done it and we'll get the same answer. I request you to take down answer. So in the first part of the question, we have computed the real cash flow or cash flow in the current purchasing power term. Second question is compute the nominal cash flow or inflation adjusted cash flow. That is the question. Of course, it is a new question, but I want somebody of you to write in the chat box that what will be the year 3 nominal cash flow or inflation adjusted cash flow. Please write that answer in the chat box for the third year end. Dear students, since it is an initial question, so I am giving you a detailed explanation. Basically, we understand something like this. Students are requested to write down answer along with me. Calculation of nominal slash inflation adjusted cash flows from end of year 1 to end of year 3. It will be found like this: first year, second year, third year. Sales. See, we have to understand logically like this. Today, the product is having the selling price of 600. After 1 year, the product would have the selling price of 600 plus 10%, 616 into number of units are 1000. So what will happen, dear students? We understand that's over here 600 into 1.10. So 660 would be the price at the end of the first year into 1000. That comes to 6,60,000. That could have been calculated directly also, 6 lakhs into 1.1. Importantly, in the second year, what will happen, dear students? We have to make an assumption that the way cost of capital is on annually compounded basis, similarly, the inflation rate is also on the annually compounded basis. So 600 into 1.10 raised to 2 into 2000. So price of this product is expected to be 726 at the end of the second year into 2000. So in that case, it would be 14,52,000. In the third year, it would be 600 into 1.10 raised to 3 into 3000. So it is 1.1023 into 600 into 3000. That comes to 23,95,800. That is the way we are required to make the calculation of the sales value at the end of year 1 to year 3. I request you to calculate the answer of the variable cost and put your answer in the chat box, that what would be the variable cost for the third year end. Of course, in the nominal term. Now, exactly the same thing will be there in case of the variable cost. So what will happen, dear students, in case of variable cost? Selling price, that is variable cost, is given 200 into 1.10 raised to 1 into again 1000 units. So what will happen? 220 into 1000, that comes to 2,20,000. Next would be again 200 into 1.10 raised to 2 into 2000. So in that case, it would be 1.21 into 200, 242 into 2000, 4,84,000. Next, it is 200 into 1.10 raised to 3 into 3000. That comes to 798,600. So we will have cash flow as a difference. 660 minus 220, that is 4,40,000. 14,52,000 minus 4,84,000, 9,68,000. 23,95,800 minus 798,600, 15,97,200. Since it is initial question, so I'm going slightly um, slowly, and I'm showing you the different working in detail. Based on this working, we can have a simple understanding that as far as the nominal cash flow is concerned, nominal cash flow is also given a name as inflation adjusted cash flow. It will be calculated as real cash flow into 1 plus inflation rate raised to n number of years. That is the way we can make the computation of the nominal cash flow. Dear students, over here, importantly, you have to understand that the inflation rate is always in the annually compounded term. So, summary of the entire answer. Basically, in this question, we are going to have understanding of only how to make the computation of the real cash flow and nominal cash flow, because we are entering into a new segment, that is the decision making under inflationary situation. Decision making under inflationary situation means that if at all the inflation is going to take place, then in that case, how to make the calculation of the cash flow. That is what we are going to understand. So first of all, sales is calculated, variable cost is calculated, and then difference of that is the cash flow. In the first question, we are required to find the answer in real term or current purchasing power term. In that case, we will not take into account the inflation. Then the same question is required to be done in the nominal term or inflation adjusted term. Dear students, you can very well understand that say directly these cash flows can also be converted into nominal term. 4 lakhs into 1.10 is 4 lakh 40,000. 8 lakhs into 1.10 raised to 2, it is 9 lakh 68,000. 12 lakhs into 1.10 raised to 3, you'll get answer of 15 lakh 97,200. So we logically derive a formula: nominal cash flow or inflation adjusted cash flow is equal to real cash flow or cash flow in the current purchasing power term into 1 plus inflation rate.